Greetings. I'm Ahmed Abdulrazak, the CEO of Endless Money, and here with me the CFO, CMO, and CEO to present and discuss the performance of our company over the past 7 years. Overall, we did well in the game. We were profitable every year and with good credit rating. We had a good start in the first year, but then our EPS and ROE started dropping in the next 3 years. However, we managed to turn the company around and started to improve our performance. And we managed to win in year 16 and we ended up in third overall. For the initial strategy, our initial strategy was to be a value brand that minimizes cost and be in the middle in quality and models offered. We started with 200 models and 5 SKU rating while providing below the average price. We thought that being in the middle would appeal to a larger number of customers and would allow us to be flexible in going up or down in quality depending on how the other firms are doing. As for our corporate strategy, we planned in competing in all regions and in all market segments. This would provide us with the economies of scale to minimize the cost and would allow us to be flexible in reacting to changes in exchange rate and growth rates. Moving forward, however, one big issue was in private label, which became risky to compete in. More companies than we expected were competing there, which made margins much lower than we were hoping for. Also, we were losing some big bits, which was hurting us in the unit cost of the brand choose. As a result, we changed our strategy in private label in later years. Instead of seeing private label as a segment to gain profits in, we use private label as a way to minimize the cost of branded sales. So we ended up pricing almost at cost in private label to make sure that we win the bids and enjoy the low manufacturing costs. Other than that, we mostly had implementation mistakes in operations, marketing, and finance. My colleagues will provide more details on these issues and how we improved in later years.
Good afternoon. My name is Brad Dyer. I'm the Chief Operations Officer. As the Chief Operations Officer, my primary concern was minimizing costs while keeping our strategic quality expectations. Immediately, we invested in a reject rate reduction upgrade in our Asian facility, but not in North America. Several years into the second decade, we found the position in North America unsustainable and moved manufacturing to Latin America. Labor costs and no tariffs in North America were important market forces in alignment with our overall strategy. Over the years, we invested heavily in total quality management and best practices in both Latin America and our Asian Pacific facilities, resulting in lowest cost manufacturing, lowest reject rate in the industry. The strategy gave us cost advantage in private label contracts, which further reduced our manufacturing costs. Capacity utilization was strong through most of our decade, less the transition period in North America to Latin America. Aggressive private label competition and low-cost manufacturing worked in tandem to optimize utilization, which averaged well over 100%. Ultimately, our main weakness was holding on to the North American facility in hopes the quality improvements would make the high cost of labor cost effective, but market demand proved too weak to maintain facilities in Asia Pacific, Latin America, and North America. Now our Chief Marketing Officer, Vic Feldberg, will talk more about our marketing strategy.
Good afternoon. My name is Vic Feldberg. I'm the CMO of Endless Money, and today I'm going to tell you how our team marketed our shoes. Our marketing strategy was to consistently get a good return on investment for each dollar we spent without worrying too much about market share. We achieved our goals by spending 20 to 25% more on average than our competitors in wholesale marketing, offering consumers a healthy rebate and supporting our retailers better than anyone else in the industry. This strategy allowed our team to reduce our price in the quickly expanding internet segment without drastically offending our retail partners in order to keep the amount of outlets our shoes were sold in high. When it came time for celebrity bidding, our company noticed that the majority of our competitors were overpaying to sign the stars. Our approach, on the other hand, was to be prudent and to wait until most of our competitors already signed a celebrity and demand for them dropped. That way, we were able to sign the celebrity we wanted for a bargain basement price and re-sign her a few years later for an even lower price. Our strategy in regard to the SQ rating of the shoes we were going to produce was to stay flexible. We started off with a 5-star shoe, which we knew that we could easily modify up or down. As many teams were selling low-price, low-quality footwear in the beginning, our team did the opposite by boosting our SQ rating to 7. When the industry-wide SQ rating started rising rapidly later in the game, our team took advantage of the opportunity to achieve cost savings by reducing our SQ rating down to 4 and boosting marketing support to maintain sales instead. Overall, our plan proved relatively reasonable for the industry until year 16, when a new tariff was implemented. That year, we adjusted our strategy by radically decreasing our advertising in North America and Europe, where we realized that we could no longer get a good return on investment. Instead, we shifted our advertising towards Asia and Latin America, where we had good production facilities and we weren't being burdened by tariffs. Looking back, if there are a few things we could have done better, they would have been to do a little bit more CSR earlier in the game and initially put more focus on our image rating than we actually did. Even so, by year 17, our marketing effort was extremely effective. And now Grandis, our CFO, will discuss how our company's financial strategy complemented our operations and marketing initiatives. Thank you.
Good afternoon. My name is Grandis Arumansyah and I am the CFO of Endless Money Incorporated. Today, I would like to tell you about what we have done from year 11 to year 17 in terms of financial decisions. So we started year 11 by requesting a $10,000 loan, repurchasing 350 shares, and giving $0.25 per share in dividend. As we were still trying to figure out the competition, our result for that year was not stellar. We received B+ rating, EPS of $2.26, and 10% ROE. In year 12 and 13, we continued repurchasing shares, but with no dividends paid out. We also started our investment in Latin America, hence requiring plenty of our cash. Our EPS and ROE were in the low range for these periods. Year 14 and 15 showed a rebound in our performance. We started to understand the competition pattern and we leveraged our competitive advantage of having a Latin America production facility. We also refinanced our loans to reduce the interest burden because our credit rating was improving each year. In year 16, as the result of our efforts in marketing, production, and financial engineering, we managed to become the champion of the period. Our credit rating was A+, EPS was 5.01, and ROE was 16.4%. Both numbers were well above the investors' expectation. Year 17, as we always did in previous periods, we repurchased 497 shares and maintained our production scheme. We gave out a hefty dividend of $5.4 per share this year to increase our ROE. We also took advantage of the A+ credit rating by refinancing our loans. The results were pretty good. Our EPS was $7.92 and ROE was 24.5%. We closed the game with $167.1 stock price, a huge increase from $19.75 in year 12. If we were to contemplate on what we should have done to get better results, it would be first, to give out more dividends, and second, since our credit rating was very good, we could have had bigger loans to support bigger dividends and to upgrade our production facility. I think that would be the summary of our presentation today. Thank you.